So welcome everyone to this week's edition of the Commercial Real Estate 101 Meetup Group. Excited to be with you all today. Today we have a guest who is actually focused on the small bay industrial real estate. And again, sorry for being a little bit late on the live stream. We were having a little bit of technical issues early on, but looking forward to getting into the discussion to talk about small bay industrial. So, Jonathan, welcome.
Hey, Raphael, thanks so much for having me. Sorry to everyone listening and watching. I apologize for being late.
No, it's not. No, not at all. It's not a concern at all. I'm just excited to be able to talk about a really relevant subject, which is small bay industrial. So, to start out, before we dive into really the meat and potatoes of the actual discussion, I thought it'd be good to have the audience learn a little bit more about you. So, if you don't mind, kind of sharing a little bit about your backstory, that'd be awesome.
Sure. I grew up in the Midwest, grew up in Illinois, and went to college to be a special education teacher. So, following college, got a job as a special ed teacher, wasn't involved in real estate at all. And then, after about 8 or 10 years of teaching and being in the non for profit world, I realized that this teaching thing was not going to get myself and my family where we wanted to go, both financially and lifestyle wise. And so I was listening to the Bigger Pockets podcast and reading books and all that kind of stuff. And I finally flipped my first house, got mustered the courage to flip a house. And my plan was to flip houses on nights and weekends and school holidays, and then use the proceeds from the flips to buy small multifamily properties. And I was going to build an empire of small multifamily properties. And I got up to like 22 or 24 units, something like that. And I realized that it is really hard to scale small multifamily properties. And I just thought, man, I wonder what other kinds of asset classes are out there that might be less management intensive, something like that. And so I bought my first foray into the commercial world was I bought a small office building and learned a ton of lessons on that. And then I got into single tenant industrial properties. And I own a couple of those, and I'm really trying to grow that part of my portfolio now.
That's amazing. Yeah, no, that makes complete sense, and it seems that's a logical transition for a lot of people. A lot of people, when they first get started investing, homes obviously make sense to a lot of people. So it's just a natural progression to get into that space. And, some people after a while decide they want to be able to scale their operations. And therefore they look at the multifamily side as kind of a, not necessarily the same as single family residential, but there are a lot of similarities to that nuance. And then, in your case where you're describing your desire to kind of branch off into the industrial space or really just commercial in general. Obviously, there's pros and cons to each type, but your decision to move into the industrial space, especially in the last 10 years, I'm sure has served you well. Again, it's just a very high demand property type. So,
Absolutely. And to be clear, I am not anti multifamily. I still
mhm.
own multifamily. I still own some. I'm flipping a residential property right now. I'm still actively looking for residential properties as well. But the just the competitive landscape of the multifamily world got to the point where the numbers were just not making sense. There's so much competition, and prices got so heated that I just really wanted to broaden my horizons and branch out from multifamily a little bit.
No, it makes sense. No, I'll preface this as well. Like I personally have owned multifamily as well. I think it is a pretty solid property type to be involved in. But as far as the actual property type of industrial, I thought I'd want you to kind of explain a little bit about what you mean by the way the name of this podcast is small industrial. So what would you describe as kind of a small industrial product?
Yeah, so these are the very unsexy properties that you pass by on the freeway or on a frontage road or just in the industrial part of town that you don't really give a second thought to. The types of tenants that use these properties are plumbers, electricians, landscaping companies, granite fabricators, window installation companies. So these are blue collar tenants doing service oriented businesses. And the properties that I'm after are in the 8,000 square foot to 20,000 square foot range. These are single tenant properties, and so you might picture like a multi-tenant property with a bunch of bay doors and man doors. That is not what I'm after. I'm after single tenant properties, and so it's just a single standalone structure that's only occupied by one tenant. And I'm happy to go into the reasons why I like those single tenant properties if you want.
Yeah, that'd be great actually. Yeah, because to your point, there's a lot of people out there that see multi-tenant as an opportunity to help spread risk across a broad range of tenants, but there's also a lot of value in having a single tenant. So maybe we can dive into some of the reasons I guess what attracted you to the single tenant side maybe versus the small bay multi-tenant side.
Sure. And I am not anti multi-tenant.
Yeah, of course.
There's definitely opportunities in the multi-tenant world. The reason I like single tenant is because of the management piece. And so I was really looking, I'm just at a point in my life where I've got a lot going on in my personal life, and I've got little kids, and I have hobbies, and I travel. And so the single tenant property just provides, the type of low management property that I'm looking for. And so these are generally on net leases, or you might be familiar with triple net leases. And so the tenant is responsible for paying taxes, insurance, and maintaining the property. And so when it snows and the snow needs to be cleared, tenant takes care of that. When the landscaping needs to be done, tenant takes care of that. If the faucet in the bathroom is leaking, tenant takes care of it. If the light bulb in the conference room goes out, the tenant takes care of it. I'm not getting phone calls for any of that stuff. And it's written into the lease that the tenant is responsible for those things. And so it's largely a management issue. And then the other thing I really like about these properties is that the tenants are very sticky. They stay for a really long time. I own one property. It's a landscaping company. This tenant has been in this property for over 20 years. I own another property. It's a glass manufacturer. They've been in this location for over 40 years. The business itself has changed hands during that time period, but yet the brand, the business, has stayed in this location. And so, there's a lot of reasons for that, but some of the reasons are that these properties are hard to find. They're really not building any more of these, and these properties are often in like in town infill locations, and so they're centrally located for customers and clients to find them. They're centrally located for employees to be able to come to work every day and know where they're going to be working. And so those are some of the reasons that I really like single tenant.
Yeah, yeah, and even the size that you're targeting, 8 to 20,000 feet. I mean, that's a size that a lot of more mature businesses are targeting. You're not really going to have, at least to my knowledge, you're typically not going to have a startup take up, you know, 10 to 20,000 square feet unless it's like a super heavily backed startup and they're utilizing the space for a variety of different reasons. So I'd imagine as part of the analysis piece, which I'm sure we'll get into at some point, that comes into play is that, these businesses could very well be more established, more seasoned. They have more predictable revenue. So, you're going to get paid at the end of the day.
You're
And
yeah. Yeah, I mean, Raphael, you're 100% correct. When you get into the small bay stuff that's like 2,500 square feet, you really have, uh, there's a tendency to have more mom and pop tenants at that space. Some startups, people with no experience, some guy that wants to store some hot rods or something like that. But when you get into it's just like one little tier up, 8 to 20,000 square feet. These are generally established businesses. They have departments. They have payroll departments and operations departments. These are not one man shops. These are businesses that are in it for the long haul. They have experience. They have employees. They have systems and all those sorts of things. And so there's we can I'm sure we'll go into underwriting tenants. But there's a big difference between getting a tenant that's just, a mom and pop kind of guy, startup, versus a tenant that's established that has been in this location for 20 years. And so I think that's a really important differentiation that you made, that the size of the building can attract a different quality tenant.
Yeah, 100%. And I've learned that I do a lot in the retail space, and obviously, just because it's a Domino's location doesn't mean it's a corporate Domino's. It could very well be a two location franchisee, and that's going to carry a different weight than a franchisee that has 200 locations. So, the balance sheet and the P&Ls for the corporation could be very, very vastly different, even though they may have the same insignia on the front door. So, the nuances of the underwriting process are going to be different depending on the property types. And I'm sure we're going to get into some of that in this discussion. So really, I think one of the things that I'm kind of curious about is, how do you identify, or I guess what criteria you're looking for? And how do you identify some of these opportunities? Because, it's not like you can just drive in a neighborhood and there's, hundreds and hundreds of homes. These types of properties are usually in certain areas of town, and maybe there's specific types of, the orientation that you're looking for is specific. So I was just kind of curious if you could share, maybe some of the criteria that you look for as far as the orientation of the space, and then maybe also, where you're finding these opportunities.
Sure. So I have a very narrow buy box of what I'm looking for, and that means, it makes my deal searching go pretty quick because there are not many of these opportunities out there. So, like I mentioned, I'm looking for single tenant properties, kind of under 20,000 square feet. I'm looking for occupied properties that are already leased. I do not buy vacant properties, and we can, maybe go into later why I don't buy vacant properties. But looking for leases that are expiring or close to expiring, so like 18 months or less left on the lease, and rents that are below market. And so, kind of when you put all of those factors together, it creates a value add opportunity. And so, generally, these tenants, when I'm looking for an occupied property, the tenant generally wants to stay because it's very difficult and very expensive for the tenant to move. There are just not a lot of opportunities for these tenants to find different properties, that are going to match these characteristics. And so, like I said before, tenants are very sticky, and so that tenant probably wants to stay. And if they've had a lease for 5 or 10 years, they're probably paying below market rent. And so that's an opportunity when that lease expires that I can move that tenant up to market rent. So, for example, uh, a little over a year ago, I bought a property in Oklahoma City, and the tenant had about 6 months left on the lease. They wanted to stay, and I think they were paying about $5 a foot, and market is $8 a foot. And this has been a tenant that they've been in this location for 25 plus years, and they've had a long-term lease, and the lease has just not kept up with the market. And so they were paying $5 a foot. So, 6 months later, I could bump them up to $8 a foot. That's whatever, 30, 40%, even more than that, percent increase in rent. And they paid it. They wanted to stay because there was nowhere else for them to go. And so that is kind of an ideal, kind of strike zone for me of the types of deals that I'm looking for. They're rare, because the sellers in this situation they're selling low. And in a couple of my recent transactions, the sellers have been retiring, and so they don't care about selling low. They don't care about renewing the lease and getting maximum value. They were at a point in their lives where it was time to sell, regardless of what the lease structure was, regardless of what the rent was. They're just ready to sell and simplify their lives and move on. And so those are the types of opportunities that I'm looking for. In terms of where I'm finding these opportunities, I mean, they come from all over. So I've got a Crexy search set up. And so I search Crexy every single day. I have a really narrow search in, so I just click my saved searches and see what new properties come up. And if anything looks interesting, I'll call the broker, have a conversation. I bought a deal. I closed on it earlier this year in January. It was totally off market. It was a pocket listing from a broker. This broker had just sold a deal for me, and so he knew I had money to spend. Told him exactly what I was looking for, and he came to me the next day saying, "Hey, such and such building, I think that's available. Are you interested in it?" I'm like, "Yeah, count me in." And so that's how I was able to get that deal. I do some direct marketing and some cold calling. Haven't landed a commercial deal through those means yet, but yeah, those are some of the ways that I target deals.
Definitely. No, that's great. And you referenced Crexy, which I know I've been trying to get more and more people on up to date on Crexy. I mean, I use Crexy a lot. And it's kind of becoming the alternative to CoStar and LoopNet, because LoopNet, I mean, you're familiar, I'm sure. It's a lot of it's outdated information, and it can be kind of cumbersome to use sometimes. And Crexy, they've done a really nice job of being able to present. I mean, again, it's been wide market adoption on the brokerage side, and I can speak from that perspective. So but anyway, so yeah, that was kind of a unique perspective to share regarding that. And then also you referenced the broker community. I mean, that's another thing. A lot of people think that, they can, not to say that you can't find off market opportunities. That is definitely a big thing. And especially if you can leverage those, if you can find those opportunities, phenomenal. But 80 to 90% of all the transactions that occur on the marketplace, again, are involve some form of brokerage relationship. And so being able to understand who's operating in that space and operating at a high level could very well help you in your cause, especially if you showcase your ability to close. Because at the end of the day, as a broker, you're trying to vet and identify individuals who can execute, because at the end of the day, brokers don't get paid unless the deals get closed. So, yeah, just kind of reinforcing that idea for people who are listening that are looking for these types of opportunities. So, but
Yeah, absolutely. And establishing broker relationships and your ability to close, definitely crucial. And you don't have to have closed, hundreds of deals, but some sort of track record. The fact that you've maybe talked to a bank and that you're, pre-qualified for a loan, you have a relationship with a bank, and you're talking about getting lending. I think, and correct me if I'm wrong, but I think that goes a long way with a lender. If you just say, "Hey, I'm ready. This is the bank that I'm going to use. These are the terms that they've agreed to if I find a deal that meets these parameters." So just showing that you're not a tire kicker, and
mhm.
you're ready to pull the trigger on a deal, I think goes a long way with brokers.
Absolutely. And providing feedback too, because there's nothing more annoying than someone who says, "Hey, this is what I'm looking for," and then you present them with a potential opportunity and it's just crickets. It's like, okay, well, why waste my time trying to, you know, I'm not going to go through the process of trying to continue to keep you up to date on things that are available if there's no feedback being provided. So, that's another piece that I would definitely recommend people do, especially if they're looking to acquire these types of opportunities, is that you got to provide feedback constantly. And even if something doesn't fit, just be like, "Hey, I really appreciate you sending this opportunity. These are the reasons why it won't fit me, but keep them coming. Keep sending me these types of opportunities, because I'm sure something's going to stick at some point." So, but
Yep,
yeah,
absolutely. Yep.
so one thing I was curious about is, obviously now we've kind of identified, why you like single tenant industrial within those parameters. You've kind of identified how you're finding these opportunities. Obviously leveraging platforms like a Crexy, your broker relationships in the area that you're focused in. Now, let's say that one of these brokers, or you find an off market opportunity that kind of meets that criteria, like that preliminary buy box. Can you kind of share as to some of the analysis that you're doing to determine whether or not it's worth pulling the trigger, and if so, like how you're going to make the offer and terms?
Sure. Um, Gosh, where to start? So let me maybe I can just talk about some deal breakers, and
Sure.
so like just some quick kind of back of the napkin math, or just some quick metrics that I look at when I'm looking at a deal. So say something comes up on Crexy, and it does almost every single day. These properties come up, but almost none of them fit my criteria. So like one deal I passed on, single tenant, occupied, below market rents. But the tenant and landlord recently agreed to like a 5-year lease extension. And so that was going to bring the total lease length to 7 years. It wasn't going to mature, the lease wasn't going to expire until 2030 or 2031. And they're paying below market rent. And so I'd have to be basically stuck with this tenant with super low rent for the next 6 to 7 years. And I'm a value add investor. And so those types of those types of opportunities are a pass for me, because I want to be able to add value really quickly. So like 18 months or less. 7 years is just too long. Talk to me in 6 years. If that deal is still available in 6 years, then I'll go back to it and consider it. But right now, that deal's a pass for me. Another thing is price per square foot. So in almost all markets across the country, these deals are going to rent for somewhere in the $6 to $10 a foot range. And so I can sort of back into the returns that I'm looking for. And for the most part, I need to purchase under $100 a square foot. And so one of the searches that I have set up maxes out at $100 a square foot. That's just from the underwriting that I've done. That's just the general area that I need to be under in order for a deal to make sense and to provide some returns. And so you might see some of these deals that are, I see deals that are priced at $200 or $250 a foot for a flex industrial property. And those deals just do not make sense. And in general, those are priced for owner users, like
Mhm.
someone with a business looking to occupy space. Those types of purchasers, those types of buyers are just willing to pay more than an investor because they don't need a return. They're looking for a spot for their business. Whereas someone like me, I'm an investor, call me crazy, but I need a return on my investment. And so it really needs to be under $100 a square foot. So when I see pricing that's over that, it's a pass for me because I know the numbers just aren't going to work. Um, do you want to go into talking about underwriting tenants right now as well?
Yeah, we could touch it on the tenant side too, because that is just equally as, if not more important, of the underwriting process. Because you could have a tenant paying great rent, but if they're not worth their weight in salt, it doesn't really matter what it's not worth the paper it's written on. So,
Yeah, crucial point there. The broker might be advertising, we've got a lease and they're paying this amount. But then when you look at the business and you're like, is this business even making money? And it's not making money, then there's a really good chance that that tenant is going to default at some point in the future. So I'll give you an example of there's a property that fit my criteria. It was actually a sale leaseback, and the building was attractive enough, and the rent was attractive enough. The returns, the rent was actually below market, which I was okay with because the sale price was reflective of that. It was priced at a 10 cap, so I'm like, okay, 10 cap on day one with 3% annual increases. This is something I can get behind. But then once I started vetting the tenant a little bit, it was just, it had to be a pass for me because the tenant was a solo operator. The tenant had a separate W 2 job, a full time W 2 job. And so that told me that the tenant was probably not going to be able to give his full attention to this business. And then the tenant also wanted some other kind of crazy requests at closing. The tenant wanted a hard money loan at closing. They wanted to sell their real estate and get a $100,000 hard money loan at closing. So that told me that this tenant's broke. This tenant is selling this real estate to generate cash, and they also want a hard money loan at closing. In this case, I was also able to see the tenant's personal financial statement, and so I was going to require a personal guarantee and a corporate guarantee if I was going to follow through on this purchase. And so the first step was seeing the tenant's personal financial statement. They had loads of debt and they were trying to get more debt. And so, that was a pass for me because the writing was on the wall with that this tenant was not going to be able to keep up their end of the bargain of continuing to pay rent. And so, in a lot of cases, with established tenants, with established leases, the lease is going to guide what sort of financials the tenant has to disclose. And in a lot of cases, in most leases that I see, the tenant with these types of properties, the tenant doesn't have to disclose any financials. And so, you can ask, but the tenant is probably, if they're not required to, they're probably not going to provide profit and loss statements and personal financial statements and things like that. And so you have to do other things to vet the tenant, like you can look at Google reviews and see how
mhm.
many reviews they have. How many recent reviews, how many recent complaints. You can, do anecdotal things like do drive-bys or just, sit on the street, see what kind of activity is going on. And then also just, you know, considering the length that the business has been there. If the business has only been there a year, there's probably some more risk with that. But if the business has been there for 20 plus years, they're probably established. They probably have some good clientele, and they're probably going to stand the test of time in that location. And then the other thing that I do to kind of bypass all of this is to make sure you're buying a quality building. So real estate fundamentals in this asset class still apply. And so you are buying the lease and you are buying a stream of income. But more importantly, you're buying the property. And so you've got to love the real estate. So if worse comes to worse and you have to evict the tenant, or the tenant just chooses to leave on their own at the end of the lease, you have to feel really confident that you're purchasing a quality building that's in demand, that there's a low supply of, that you're going to be able to lease up to another tenant.
Yeah. Yeah, that's a huge point. I appreciate you sharing that insight, because a lot of times people get caught up in the numbers of it, but they don't really think about the implications of the actual structure, because you could have a tenant in a functionally obsolete building that has, let's say it's a low ceiling height, maybe it's a 9-foot ceiling in the warehouse space, and it's more than half office, and so the demand profile for potential tenants for that type of product in this environment is much lower than it was maybe in the 50s, 60s, whatever that time was. But nowadays, obviously, taller ceilings are a value because of the fact that warehousing has become much more in demand. Storage capacity, you can store more with taller ceilings because you could stack product as opposed to leaving it on the floor. So that's something that's a value. The demand for office space is definitely not as much as it was pre-COVID. So, the orientation leaning more towards warehousing versus office is a value. So these types of characteristics of structures is worth noting when you're looking at these buildings, and not just looking at the lease, although the lease is very important, especially because it's going to be an investment property. But, to your point, if for whatever reason, 3 years in, the tenant decides to fold up or maybe vacate or whatever, you have to feel pretty comfortable knowing that, okay, well, even if they do vacate, maybe it's an even better opportunity for me to now backfill. So,
Yeah,
that's
really good points there, Raphael. I'll add something that I look for is the ratio or percentage of office to warehouse. And so a broker brought me a deal a couple days ago, 10,000 square foot, single tenant. But the ratio of office to warehouse, it's about 4,000 square foot of office and 6,000 square foot of warehouse, and that's just too much office. Most companies these days don't need that much office space. In a 10,000 square foot building, I would want to be more in the 1,500 square foot of office and then 8,500 square foot of warehouse, because companies these days, they just want more warehouse space to store stuff, park their vehicles, manufacture, whereas there's less emphasis on office right now.
Definitely. Yeah, no, I couldn't agree more. And then, on the tenant vetting side, I appreciate your insight as well on the lease. The lease is going to guide what you can and can't request. I know in retail, it's very common for you to request unit financials, which is like, the single store, they'll provide you with the ongoing P&L. And then sometimes if there's a guarantee involved in the corporate level, you can request corporate financials. And most of the time within the lease agreements, they are able to disclose that. And, to your point regarding revenue, we always look for rent to revenue ratios when we were analyzing these types of opportunities and saying, okay, well, if we were to raise the rent to this amount, can the revenue and the margins that they clear justify or support that type of metric? So, with restaurants, it's in the 5 to 10% range. So if you're charging 10 grand a month in rent, they got to make, at a minimum, over $1 million a year to really justify the cost of the rent, because otherwise it's not really going to be something that's going to be a fruitful endeavor for them. So there's different ways you can look at different things at a high level to just, and as you do this more and more, you start realizing, oh, okay, this could work, this may not work. And so it's just over time, you get to refine your underwriting on these deals. So
yeah, great point. I wish I knew a metric in the industrial world for this type of asset class. I typically don't see financials of my tenants. It's typically not in the leases. And so, I wish I had like a rule of thumb of, 8 or 10% of gross revenue, but I'm not at the experience level yet where I can.
No, and it's not even the experience level. It's what's the norm in different property types, because what's common in retail, for example, is not going to necessarily be common in industrial, and that's one of the beauties of the commercial space, is that there's all these nuances, and depending on which property type you decide to pursue, then there's different things you need to learn to make sure that you're making the right decision. So, so let's say, you've identified a property, someone's brought you an opportunity, you've underwritten it, it looks great, and you say, okay, well, now I'm going to go ahead and pull the trigger. You go through the process of closing on the property. What does that next, call it, 12 to 24 months look like? While as you're executing the business plan, let's say that you bought this property and the lease is expiring in 8 months.
Mhm. So before I close, I really want to have a conversation with the tenant to find out what their plan is. The tenant knows their lease is expiring. They are very aware of that, because the tenant is, in most cases, businesses are making plans. They have 3, 5, 7, 10-year visions of where they want to go. And so they're very aware of where they're at in their lease because they know they're stuck. They've got a 10-year lease. They know they're not moving for 10 years. They know they've got 6 months left on their lease. They know, okay, we've got a decision to make. We're either happy where we are, and we want to sign a new lease, and our rent rate might go up, or we're looking to move. And if you're at if you're at less than 12 months with a lease remaining, the tenant has a really good idea of what they want to do. And so, in almost every scenario, I want to have a conversation with the tenant. I put that in my LOI and contract that I want to have a conversation with the decision makers, who are occupying that building. And it's at that point, it's not written in stone. These are verbal conversations. I'm in general, I'm not signing lease extensions while I'm under contract before I close, but I'm getting a good idea of what the tenant is thinking. And so on day one, after I close, depending on what the lease says. So I'll give you an example. This um, building I closed on last year in Oklahoma City, when I closed on it, there were 6 or 8 months left on the lease. I believe the clause in the lease said that the tenant had to notify the landlord within 6 months if they wanted to renew their lease. After the 6 month mark, I could start marketing that place for lease. And so, really, almost on day one after I closed on that building, I went to the tenant and started having serious conversations. You want to stay? Okay. And then they did want to stay. And so then we started having kind of general conversations about the outline of the lease structure. I wanted a 7-year lease. And so I proposed to them a 7-year lease at $8 a square foot. They said, we don't sign, it's a corporate policy. We don't sign 7-year leases. The max we sign is 5-year leases. And so at that point, I had a decision to make. So I could dig in my heels and say, no, I want a 7-year lease or a 10-year lease, and risk having a vacancy. But instead, I budged and said, okay, 5 years, I can live with 5 years. Here's going to be the rent rate. And so then we kind of had a back and forth of the rent. That was, the lease. Getting a new lease was really the most important part of that deal. They didn't have any capital improvement requests. They didn't want me to put any money into the property. They wanted to stay. And I think actually this particular tenant, it's a landscaping tenant. I think they were really worried about getting kicked out.
Mm-hmm.
I think in the bidding process, there were multiple offers. And in the bidding process, I think some of the bidders were rival landscaping companies. And so they thought there was a chance that a rival landscaping company was going to buy their property, kick them out, and occupy the space. And so
Mm-hmm.
I think they were relieved that I bought it as an investor and I wanted them to stay. And so I increased their rent, got a really nice rent bump, got a 5-year lease extension with a 5-year tenant option at market rate. And so those were the most important things there for me. And then, as far as the lease process went, their previous lease was like over 20 years old, and so I wanted to redo the lease just on updated paperwork. The old PDF was just blurry and like sideways and kind of diagonal, and so I redid the lease on new paperwork, and we had a couple things that we went back and forth on, things like HVAC is what I'm remembering was the biggest thing,
Mm-hmm.
something we went back on. And so I drafted the lease, and got it like 95% of the way. The tenant had an attorney. They have like an attorney in house that I was working with for the lease. And then after we had it like 95% finalized, I hired my own attorney. and had them look and had her look through the lease, give me anything like, hey, what am I missing? Anything I should be aware of here? She gave me a few things to look out for, and some wording modifications. And then after that, we signed the lease. And I mean, beyond that, I schedule a cost segregation study. So I went back to the property to get a cost seg done. But beyond that, I might check in with the tenant quarterly, maybe semi-annually, just to say, hey, hope everything's going well. Let me know if you need anything. But yeah, I mean, the tenant knows they're on a triple net lease. They know they're responsible for everything, and so there are very few things that they come to me for.
That's great. Yeah, and I appreciate the insight you shared regarding the, the conversation piece where it's, you start having those conversations with the tenant and really get a gauge for what their desire is post, closing and ultimately getting the lease signed. So, and I'd imagine a lot of these situations when you're working with tenants that have been on site for a while, the paperwork that was in place when they first got on was very outdated. So, working to try to have a very strong lease agreement is great. And I always encourage my landlords to work with an attorney to draft something, or even if you have a base model that you have and you feel like it's covering most of the things you need to, having an attorney that's been there, done that a lot is of value, because there may be something you may be missing, and that's a document you're going to live with for potentially over a decade if you have a 5-year lease with a 5-year option on the back end as well. So, very valuable information there. And then also to the point, I would imagine in a lot of these situations, a lot of tenants already have triple net leases in the past. So maybe they're familiar with that type of process. But if they're not, then educating the tenant as to what the new expectation is could be very valuable as well, because, and I'm not sure if you've ever had to do that. I've definitely dealt with tenants and again, I'm speaking from the retail side. A lot of times you get with landlords that have like gross leases or modified gross leases in these shopping centers. And then you get on site and convert the tenants over to triple net. And there's a huge stink about the fact they have to pay part of the taxes and insurance and maintain their own spaces. And it's like, well, that's just how market is. I mean, it shouldn't be a shock to you, because if you go try to do the same thing elsewhere, you're not going to find what you have. So it's like one of those things where a lot of times tenants are spoiled for a long time. And then when you get to really you have to bring the property up to market, because you need to be able to make a return and also be able to maintain the property, because some of these landlords, I don't even know how in the world they're maintaining their property while they're charging what they're charging. Like, it's just a base. Essentially, they're charging just enough to skate by, but not really making sure they can properly maintain what they got. So
Raphael, you touched on the idea of communication and just having an open communication and an open dialogue. I think a lot of those tired landlords with outdated leases and below market rents, they're not willing to have difficult conversations with tenants that says like, hey, you know what? I appreciate you. I value you, but the market is changing. My taxes are going up. Insurance is going up. Operating costs are going up. Labor is going up. Your rent has to increase by 5% or 10%. A lot of, old school landlords are not willing to have those conversations. And so I find that tenants just really value an honest business conversation, so everybody knows where they stand. If you want to kick this tenant out and you want to get a new tenant in there, be honest with them and just go by the lease and say, hey, you've got 6 months remaining on your lease. You're going to need to find a new place to rent. I'm going to do renovations, or I'm going to find a new tenant, or I'm going to do whatever. This setup is not working, so I'm going to find a new tenant. Just being straight up and very honest with your tenants goes a long way.
definitely, no, I couldn't agree more. Honesty is the best policy, as they say. But last thing, out of curiosity, is more so, and I'm not sure if you've done this as of yet, but as you start to scale, sometimes you run out of capital to be able to acquire these types of properties. So I don't know if you've gotten to the point yet where you're starting to raise money to acquire some of these deals, but just thought I'd kind of throw that out there, and just because we just closed on a property we're going to do a development project on, and this is the first time I started raising money. So there's definitely some nuance to the process, and I was curious if you could share some insights to that if you had experience thus far. So
yeah, look, everybody runs out of money. Nobody in this world has a finite amount of money, and so yes, I've run out of money, and I do raise money. I call it private money from friends and family. I'm not somebody who's on Twitter or LinkedIn trying to get strangers to invest in my deals. There are people that do that. That's totally up to them. That's just not my style, and it's not the kind of business that I want to build. And so I do have investors on my deals, and so they're private money loans, which means they're secure. Which means that it's not hard money, but it's a higher interest rate than I'd pay to a bank, but it's very flexible. And so I have a conversation. I call up a friend who has loaned on previous deals, and I say, hey, I've got this deal. This is what it is. This is the business plan. This is when you'd potentially get your money back. Are you interested in lending? This is the amount that I'm looking for. And sometimes it's a yes, sometimes it's a no. But at this point, I have relationships with the right people that I know what they're looking for, and I generally know that it's going to be a yes when I bring an opportunity to them because we've established trust and a business relationship, and so all of my most of these lending relationships are secured by a mortgage and a promissory note, and so I can't sell the property without paying them back.
Mhm.
And I just do like a fixed rate of return. And so in general, it's 10%. There can be some variation with that depending on the circumstances, but in general, it's 10% return, annualized, paid monthly. And for the most part, my investors are really happy with that. It's a super safe investment because it's secured by a mortgage and a promissory note, with long-term leases, and I have a track record. With some of my investors, we've done 5 or 7 deals together, and so they know how I operate. And but I would say for people starting in this world looking to raise money, just start having conversations with people that in your past have expressed interest in real estate. Maybe they have real estate of their own. Maybe they've just said, hey, it'd be cool to own some real estate one day, but I'm so busy and I don't know how to do it. Those are the types of people that you can talk to and say, hey, if I had a deal, would you be interested in going in on it with me? And there's all different kinds of setups you can do. You can do JVs. I just do kind of a straight debt lending relationship, but there's a lot of different ways that it can be structured. You can syndicate it. I've
Mhm.
never syndicated a deal. I'm not interested in syndicating deals. That's just not where I want my business to go. But there are ways that deals can get funded if you don't have the money.
Yeah, no, for sure. I couldn't agree more. And the money that we've raised thus far is similar to you, where it's friends and family and people that we've known and built relationships with over a long period of time. And a lot of times they're more so investing in you as an individual and the trust that they've built with you than they are in the actual deal. Obviously, the deal has to make sense. They're not going to just invest in a deal because it doesn't make sense. But in reality, if you don't have a track record, at least in this vertical, most of the time it's just you're building relationships. They're investing in you as the individual, and so as you start to build up that reputation, then obviously then you can start potentially scaling to other sources of capital. But yeah, that's great advice that you shared there, and I appreciate the strategy you're pursuing more so on the private money side versus the JV side because it does make it a little bit more complicated as you have multiple different stakeholders that want to have a say in the actual project so delineating that is extremely important for sure.
Yeah,
so
absolutely.
so last thing that I was going to ask before we open up to a quick Q&A is what are some of the best resources that people can leverage to try to learn about some of the topics we've talked about today, which really is related to industrial product.
Yeah, it's tough. I mean, so one resource is Chad Griffith's
Hmm.
Industrial Real Estate Investing podcast. So viewers are probably familiar with Chad. I know he's a buddy of yours, and so he has one of the only industrial specific podcasts, and so that would be a place to start. Um, I started my own podcast because I was in this position. I was trying to learn commercial real estate, and I'm like, where do you learn this stuff? I don't know where to learn this stuff. And so I started my own podcast called The Source of Commercial Real Estate. And so I'm like, if I can't find anywhere to learn, then I'm going to do it myself. And so I have conversations with people. It's not industrial focused. We do talk about industrial, but we also talk about retail, office, a little bit of multifamily. But yeah, I talk with brokers and investors and attorneys and all kinds of people in the commercial world. And I started it for selfish purposes so I can learn, and then so I can share it with others and other people can learn along with me. A book that got me interested in commercial is Brian Murray's book, Crushing It in Apartments and Commercial Real Estate. He talks about some multifamily in there, but he also does talk about commercial in there as well. That piqued my interest. And then, doing my first deal, that first deal was an office building. And gosh, I learned so many lessons about how to, what tenants look for in a property, how to find tenants, how to do a commercial lease, what tenants get scared about in commercial leases, what tenants are willing to pay, what sort of amenities tenants are looking for. So that office building, we didn't talk about it, but it's just a low stakes kind of deal that I could learn tons of lessons on. And so I'd say your first commercial deal should be small, something that if it goes south isn't going to kill you. It's not going to ruin your net worth or cause you to file bankruptcy or anything like that. Start small and learn some really important lessons on small deals so that later on, once you're informed and you've learned those lessons, you can do some bigger deals.
Definitely. Yeah. And I to your point, I don't think there's much substitute to actually owning it. So,
Yeah.
I can't tell you how many lessons I've learned through owning multifamily properties, dealing with tenants and working through situations that come up, and sometimes having to be a referee, which is never fun, but sometimes you got to
Right.
be the person to do that. And then on the commercial side, same thing. There's nuances to the different property types, and the things that people are looking for are going to be different. So, you know, try to see if you can take down a project that is manageable for you all, and just get in the game. Because
Yeah.
once you get in the game and you start realizing what works, what doesn't work, the things that you should be looking out for, it's going to make it a lot easier for you, and the next time around, and the next time around, and the next time around. So great points all around. All right, so I was going to open it up to Q&A. I was going to give it maybe a minute or two more. I know we're just past the hour, so I wanted to be respectful of the people, of everyone's time. So if anyone has any quick questions to ask, we'll go ahead and get going. But one thing I was going to ask you briefly before, as maybe some questions are coming in, is, do you have a question that you maybe wish I would have asked you that could have been pertinent to this discussion?
I think a topic that is or should be on everyone's mind right now is lending. So
Mm,
how are deals getting done? And so my first course of action is the thought that comes to mind is, how could I close on this in cash? And I sometimes don't have the cash myself, but I think about, okay, what investors have I talked with recently who have expressed interest in lending? So I think about, is it possible for me to close on this deal with cash? Okay. If the answer is no, if the answer is yes, okay, close with cash and then maybe figure out lending later. If the answer is no, it's just, I don't have the means to close in cash. Is this deal lendable? Can I get financing on this deal? There are the kind of the buy box that I shared with you earlier about expiring leases and that sort of thing below market rent. A lot of banks will see that and say, no, we don't want to lend on that, because the bank is thinking about risk and they're saying, okay, if this lease expires in 6 months and we lend to you on a 5-year term, how are we going to get paid back if this tenant vacates? And so they're thinking, okay, 6 months from now, the tenant vacates, you have a vacant building with no income coming in. We still have 4.5 years left on our term. No, 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 we don't like that. And so lending on these types of properties can be tricky. And so one trick or one tactic that I use is having relationships with banks. So I have two banks that I've done the majority of my deals with. They're small, local community banks, and they're comfortable with the types of deals that I do. And even if it's an expiring lease, even that office building, I bought it vacant. I had a bank give me lending on that vacant office building. And that was because of my track record and the relationship that I had with that bank. And so figuring out how you're going to get lending. If you're in a W 2 and maybe you're thinking about leaving your W 2 to pursue real estate full time, think really carefully, because after you leave that W 2, it's going to be really challenging to get lending. And so maybe start your portfolio while you still have your W 2. establish some banking relationships, and then quit your W-2 in a year or two after you've got those banking relationships and those loans. And so those are some of the things. Lending, I think, is one of the trickiest things right now because it's just going to depend on the deal and your balance sheet and your relationships and your track record. There's no cut and dry that this type of property gets lending and this type of property doesn't get lending. It totally depends, and you learn that by having experience and talking with lenders and trying to get lending and getting denied and asking, why am I getting denied? What is it about this deal that makes you not want to get involved with it? And so that just comes from experience.
Yeah, no, another great point. Building those relationships with local and regional banks in particular, because they're the ones who lend likely the most in these types of, not institutional level type deals. We're talking the ones
Right.
that, people like us can, at least our stages can take down. So very important to make that distinction. And the reasoning for that obviously is because a lot of these banks keep the loans on their books. So they're constantly reevaluating their portfolio to make sure that they're in line with their, deposit to loan ratios. That's like all of it, super important on the banking side to confirm that they actually are, whether or not they want a loan or whether or not they don't. So sometimes you may catch a bank that you've done a lot of deals with, and all of a sudden they get directive from their board saying, no, we're not going to loan anymore on this property type, or maybe in commercial real estate at all. Maybe now we're looking for just deposits. So that happens. And in this environment, it's more common to have those types of conversations with lenders. They're saying, well, maybe our loan to deposit ratio is out of whack. So really what we're focusing on now is deposits. We're focusing on lines of credit cards, that sort of thing. And so maybe that bank is not a good fit, but maybe there's another bank that maybe their ratios are more in line, and now they're more aggressive when it comes to the deals that they are willing to loan on. So it's always evolving. It's always evolving.
Yeah, such great points. I think for new investors, it's a good goal to, make it a goal to have one or two bankers that you have the relationship with, that you can either just send an email or a text or give a quick phone call to their cell phone. You can say, hey, I'm looking at this deal, 123 Main Street. What do you think about it? Is this something that you'd be interested in lending on? Without having to call their main branch and say, hey, I'd like to talk to someone in commercial lending. Make it your goal to be able to go straight to the commercial lender to get their feedback on deals. It goes a long way.
Definitely. Well, Jonathan, I think you answered all the questions that I had, and it looks like we're all filled up as far as that's concerned. So first off, I greatly appreciate your time. I think you shared a lot of really great insights on the podcast, and I'm looking forward to hearing the feedback of all the people who are listening and watching this on YouTube. So before we hop off, how can people get in touch with you? How can people learn more about what you're doing and maybe even find your podcast?
Yeah, name of my podcast is called The Source of Commercial Real Estate. You can find it anywhere podcasts are found. And then to connect with me, I'll just send you to my website. My website is jonathanhayek.co. And you can look at a little bit of my portfolio there, find the links to connect with me and email me and find me on social and all that stuff. So jonathanhayek.co.
Awesome. And we'll make sure to include that in the show notes. If you guys are watching this on YouTube, it'll be in the show notes. And if you guys are listening to this in a podcast format, whether that's Apple Podcasts or Spotify, check out the description below and you'll be able to access those links. So, Jonathan, again, thank you so much for your time. It was greatly appreciated. For those of you guys who are watching this on YouTube, we would greatly appreciate if you could like and subscribe. It makes a huge impact on our ability to reach a broader audience. Along with that, if you guys are listening to this in a podcast format, whether that's Apple Podcasts or Spotify, please leave a 5-star review. It really does make a difference in our rankings, which ultimately means that more people can listen to the podcast. So thanks again so much for tuning in, and we'll see you all next time.